Wow, hard to believe, but we've had a year's worth of news in just the last couple of weeks. We're going to try to remain open-minded and just observe this in real time. So Steve, where are our heads at after the just deluge of news?
Frank, let's first start talking about what the news is, and then we can talk about what that ultimately means. Scott Bessent, the new Secretary of the Treasury, when asked about the green energy race between the US and China, retorted, it's not a green energy race, it's an energy race. The Trump administration is looking to fast-track permits on federal lands for gas-fired power plants, these pro-nuclear, pro-energy. They're looking to reduce regulatory burden to help us produce more power. This is primarily, we think, for two real reasons. One, we're looking to onshore a lot of manufacturing to the United States, and that requires power. Over the last 20 or 30 years, we've offshored much of our manufacturing base and unfortunately hollowed out part of the Midwest to Asia, China specifically, and that's coming back. Secondly, there's an AI race here, and as Ray Dalio just said, this is a race that we cannot lose at any price. So we, according to not just Google, Meta, OpenAI, but also the US government, need to be the winners in artificial intelligence for our military and for our leadership in the global economy. And that requires power. We can debate how much power. I know there's been some recent news about potential improvements in some of the new large language models that are coming out of China, but the race is on, and the capital budgets have been set at levels that are in some ways mind-boggling. Microsoft announced $80 billion capital spending this year. Meta announced a $65 billion budget. Trump came out with OpenAI, Oracle, and SoftBank announcing a $500 billion commitment to Stargate, which is an AI push to make us, the United States, the leader here. The second thing that we cannot emphasize enough is the push for less regulation. Stanley Druckenmiller, Source's old partner, who's been an amazing investor, has commented that the CEOs he talks to are not just optimistic, but in some ways giddy. And that giddiness is really a reduction in regulation and roadblocks that have, in a lot of cases, slowed down investment in American businesses on US soil. So we're seeing a shift change in optimism, and the people that are optimistic are the ones with the capital, and that matters. Third, Trump's making deals. We'll see how many deals he ultimately makes or doesn't. He just cut a deal or announced a deal with Saudi Arabia to invest $600 billion over the next 4 years on US soil and US projects. What those are, the specifics, we don't know. We mentioned the Stargate of $500 billion on US soil. There will likely be others. We are observing even his deal making with Canada and Mexico on threats of tariffs so that the Mexican government can curtail some of the illegal immigration we're seeing across the border. We're seeing that drop dramatically. Partially that's threat and posturing. Where these deals ultimately land, we don't know, but there's more deals and negotiating to go, and those are likely positive for US-based investment. Trump zoomed in to the World Economic Forum, mandating that global rates have to come down. Trump may be president of the United States. He's not the almighty. How that ultimately happens is less clear to us, but he is a real estate guy. He wants lower rates. He can rant and rave about it. That we will see, but we will note that at least in Trump's first administration, the dollar on a trade-weighted basis, value went down. And that was positive for US exporters and US manufacturing. And he is saying publicly that he wants that again. So we do know that to be the case.
Steve, just on Deepseek, I know one of the early theses that we've had is just the demand for electricity, which you just articulated. To what degree should we be worried that Deepseek threatens that?
It's a really good question, and we don't have all the data. What's clear is it works, and they are getting accolades and praise from some of the top tech minds in the United States. So that's not of question. What is of question is, how do they do it? Did they have access to chips that they weren't supposed to have? And what did it ultimately cost? I'd argue that this is actually really good because it democratizes artificial intelligence to less than the top companies if they're successful, and makes it more accessible and cheaper to the S&P 493.
Meaning the 493 companies that are not in the Mag 7. And just an update on the Mag 7, and the Mag 7 plus 3s, the top 10 companies now are
39, 40-ish% of the market cap.
Close to 40% of the S&P 500 is 10 companies.
Yeah. Where this goes, we don't know. There's a concept called Jevons paradox, and this is when we created the steam engine back in the 1800s. And the thought was we make energy use more efficient, we would use less of it. What's happened, and we've seen that happen time and time again, where energy becomes cheaper, we just use more of it. Our cars are more fuel efficient, we drive more miles. Our chips are more efficient, we have more chips in PCs, laptops, phones, and we just use more of it. That is likely, at least in my opinion, to happen in AI, where we are still early stages in where AI ultimately goes. We don't know. The comments out of some of the tech leaders are talking about in 2025 really putting more power into not just training, but what's called inference, and having reasoning built into AI, and ultimately, and we will see, but having AI actually help do things for us, like finally making that airline reservation that we all want, or that restaurant reservation without us actually having to do it. This is in flux, but we do believe that the potential lowering of cost here is really positive for broader companies that can use it, and that's what we see as a positive. What the ultimate energy needs or consumption are going to be, it's not clear, but what we do know is these capital programs are in place and the race is on, at least for the next 2 to 3 years, and then we need to be very mindful of what it ultimately means going forward.
So it's worth emphasizing what we would have said right after the election. We are trying really hard to stay open-minded and observe and not predict. But it sounds, if I can sum up what I just heard, it sounds like our electric demand thesis remains in place for the time being, and we continue to watch it cautiously and remain open-minded if that needs to change.
100%. Electric demand is not just artificial intelligence. It is reshoring manufacturing, it is more electrification of transportation, and electrification of our entire economy.
And just as a reminder, the electric thesis expresses itself in client portfolios in uranium and copper, and I guess nat gas as well.
Natural gas as well. That's right. What else is happening on the labor front? 2 things to note. One, deportations are starting. It's starting targeted and small, not looking to deport 14, 15 million people. It looks like we're targeting convicted felons and criminals. And then 2, there has been a notice put out to all federal employees outside of Border Patrol, military, and one or 2 other areas that have effectively offered a resignation letter and severance through September. We have read that estimates are somewhere between 5 and 10% of federal employees will likely take this, and they are also being forced back to work and back to office. We were speculating before the election what DOGE might or might not be able to do. Here are some examples of what they're trying to do. So this is a reduction in federal workforce, potentially curtailing spending, and then back to our earlier comments of reduced regulation. What that ultimately means for employment, still too early to tell, but likely means more federal employees might be on the market to work in private companies. All right, let's keep going down the list. Banks are now allowed to hold and custody cryptocurrencies and blockchain assets. That is further cementing the legality and the openness to be blockchain innovators in the United States versus pushing it offshore. We are seeing the Trump-owned companies put their own dollars to work between some of the meme coins, Trump and Melania coins. I'll leave that there. More importantly, we've just seen the Trump organization invest over $250 million in Bitcoin, Ethereum, and Solana.
So back to the S&P 500, what do we think about equities broadly here?
Well, that's a loaded question because equities are not equities. And I want to point out, exactly what we were talking about before, which is with the Mag 7 in the top 10. The S&P 500, which is a market cap weighted index, is currently trading at 21, 22 times earnings. That's towards the upper end of the normal range
Of historically high.
Of history.
Got it.
Now, we may wind up having a massive productivity boom, and those earnings do grow into and continue to support those companies. So we're not trying to say it's crazy, but we're noting the starting point. More importantly, that we'd like to point out is the S&P equal weight is trading at a 16.5, 17 times number, which is closer to historic norms. If they are the beneficiaries of AI, they may do better. And then finally, developed markets and emerging markets are trading at or below their historic norm valuations.
But shouldn't they logically be a lot cheaper, just given the Trump policies? What that would mean for, I would think, emerging markets and Europe is not good. So are these cheap valuations rational?
Good question. So we have to think about the similarities between the markets. So Procter & Gamble trades in the US, trades at a 3 or 4 point multiple, then Unilever that trades abroad. They're in very similar markets, they sell very similar products, and we think some of the companies abroad and the markets abroad offer a better value today.
So we continue to maintain our allocation to international markets?
Absolutely. Remember, the S&P 500 gets about 40% of their earnings abroad. International markets also have diversified global portfolios as well. They're not that different. We're looking at such pessimism internationally, both in developed and emerging markets, versus such optimism in the United States. We like that dichotomy to maintain our positions outside of the United States.
And it's worth underscoring that we are not investing in international markets. We absolutely avoid indexing overseas. For example, if you own the international market, you own 50% of that, last I checked, was in 3 countries, Japan, the UK, and France. 50% of the non-US international market index is those countries, just because they have the biggest market cap, not necessarily because they're the most compelling investments. We believe that active management is an absolute must in non-US markets. So we have some skilled investors, seasoned skilled investors, that are very selectively choosing a handful of what they judge to be the best companies in the world outside of the US to invest in.
Very good point. Question for you. What's your sleeper pick for 2025? Most contrarian idea.
Oh, wow. Most contrarian idea. Let's just talk about what the most crowded trade is. I've said this before, and that is the Mag 7. And I have many of my smart friends out there will say, hey, but these are companies that have such more powerful positions than large companies in the past have ever had, and that these franchises have barriers to entry, so they're going to continue to outperform and outgrow the other 493 companies in the S&P, so they deserve to be this big. There's very little good things that happen with getting older, but one is you do start to see the same movies over and over again, so I will just note that people used to say the same thing about Xerox and IBM and originally Kmart, and then it was Walmart, but then along comes, Facebook and Amazon and so forth. So we believe that the rate of innovation is accelerating, and if you believe that, I believe it's also logical to assume that the rate of turnover of leadership is changing. Well, keep in mind, ChatGPT came out of nowhere. It actually did not come out of Microsoft. Microsoft had to pay up for that asset.
I'd add on top of that, we follow where the money is and where it's most crowded. Most crowded, S&P 500 market cap.
The Mag 7 specifically.
Mag 7 specifically. Corporate bond spreads are as tight as they've ever been. High yield bond spreads are as tight as they've ever been. We're generally tilting away from those 3 areas. And then we're looking for areas where we think there's opportunity and the risk rewards are more favorable.
This is one of the most underappreciated things about allocating capital. We always think, and I think clients reward us for finding what's going to do well. And I don't think people pay enough attention to the value of avoiding things that do horribly. I think one of the things I'm most proud of in Fielder's history is that we avoided long duration bonds all the way up to the greatest bond market, at least bond bear market in my lifetime, which is 2022. So with that in mind, I think the areas that we are avoiding or at least tilting away from that you alluded to, I think is going to add real value to our clients' portfolios, which is opposed to what I call the own a little bit of everything, agnostic, just kind of own the global market. We definitely don't do that, and we think that avoiding bad areas may end up adding as much value as tilting into the great areas that we judge.
Agreed. I'm not sure if we're ready to do this, but if the federal government does force everybody back to work, do companies follow? And is commercial office real estate the buy of 25?
Wow. And I want to be very clear.
We don't have it. We don't own it.
Not yet.
Just
not
being
yet.
provocative.
That would be the most contrarian call of the decade. Even here in Nashville, which is a big growth city.
It would fix the regional banks too.
Wow. We got to get to work on this.
Yeah. We got some work to do.
All right. Well, listen, there's a lot going on, a lot in flux. I promise you that we are trying our best to remain open-minded and fluid in our thinking. That means being willing to change our mind when the evidence convinces us to the contrary. Just know that we're here for you, and we look forward to sharing what we learn in the year ahead. Buckle your seatbelt. We think this is going to be potentially one of the most interesting years of the next decade.